This is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, January 22nd, 2020. What we'll do is just focus on the broad markets here, primarily the NASDAQ 100, and I want to hit on the FAANG stocks again because to me, that is the single most important thing to watch over the next week or so. As I mentioned, we have all five FAANGs plus Intel, the sixth largest component, all reporting over the next week here. So we're going to see almost certainly at least some market volatility. Now, as I said this morning, that can go either way, but the charts, to me, a lot of conditions, which I'm going to talk on now, in my opinion, highly skew the risk reward to the downside. That is somewhat offset by a resilient trend. I always kind of factor in with my analysis, okay, you might have a bearish chart pattern, you might have some sell signals given, things like that. And you also have to recognize that right now, that and for weeks and even months now, the trend has been very resilient, just a steady grind higher with dips being bought every time you have a, like the other night, I posted Monday night, markets were closed on Monday. We had the futures down, testing that trend line support on NQ, and yet another successful defense. So that's it. Point these levels out, and I'd like to say you'll know it when you see it, as far as when the tide finally turns, because what I suspect is, and look, we're looking at this point in time just for the next correction, the tradable correction, not a 1-2% pullback. I'm talking 5-10% or more. Probably, I'd look for right now in that 10% range, because the more extreme we get, usually the larger the snapback or the reversion to the mean when it finally comes. So again, you get when the markets go up and up and up and up, dips get bought, shorts get squeezed out. It creates a lot of imbalances. Again, you have a lot of very low short interest, means that there's fewer shorts to cover, and also more flexible traders like myself, those that'll go long or short, those willing shorts able to jump in once they get those sell signals. Whereas when you have a heavy short interest, those shorts are already in. They're already in the stock or in the index, and once they're in as well, what they're going to do is cover on the dip. So what that does, again, it leads to quite often very, very sharp reversals that come out of nowhere, catch a lot of pundits off guard, and they don't understand why the market dropped so much so fast. And like I said, sentiment can change on a dime. That's one thing I've learned over the years. The market can go from the most bullish, resilient trend, or the most bearish, to all of a sudden an explosive rally mode. Just think back December 24th, 2018, and what followed after that, or think back at the top just before that in early October of 2018, before the market plunged over 20%. And if you were trading at that time, you'll know everybody was extremely bullish at the top. It felt like this, and just a few weeks later, things had changed, and even really, well, I won't say the first few days, that's where you have to hit a point of what I like to call the point of recognition, where when you finally get a correction, the dip buyers, it's like Pavlov's dogs. When you ring the bell, the dogs salivate. They think that food's coming, because that's what Pavlov did. He would ring a bell, the dogs would be fed, and so then after a while, he would just ring the bell, not feed them, and they started to salivate. And that's conditioned stimulus equals conditioned response is what it was. So the dip buyers are used to being rewarded by stepping in at these support levels, especially something like this. You have a trend line, boom, 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 buy the dip, buy the dip. It works until it doesn't work. Every now and then you'll get the trend will start to be called into question. But even back here, if you recall, this was the big level at the time, 86.94 right there. Had it as the yellow line, the most important level back then. We had several tests of that level, and we held it again successfully there. So we never even we started to see volatility expand. I really thought there would be a good shot we would break it, but we didn't. We didn't get that sell signal, and we didn't get it the other night either. The bulls stepped in and they bought support there. So right now, as you can see on this 60-minute chart, the key levels, and yeah, there's been a few reactions there. So let's just color code that yellow, just giving it I'm giving it yellow just means more significance in the near term. These aren't key levels that will trigger the next bear market or anything like that, because this is a 60-minute chart. There's things that have to happen on the daily, and more importantly on the weekly charts, to trigger longer term sell signals, and we're comfortably above those levels right now. It would take quite a bit to the downside to even get some longer term sell signals. Right now, we're just looking for the next tradable correction. And again, I want to do this video because we do have the FAANGs coming up. And if there is going to be a catalyst, we already know now missiles, Iran firing missiles on 2 U.S. military bases isn't enough to take this market down. That's all that it was good for right there. And who would have thunk that? So it shows you the resiliency of the trend. It's going to take, in my opinion, probably a surprise, a disappointment in earnings or guidance on some of those big FAANG stocks. And let me just reiterate, that's a potential catalyst. It's not anything I'm going to go bet the farm on right now that all Apple and Facebook and Amazon and Microsoft are all going to miss earnings or come out with horrible guidance. And I'll also say this, I've traded long enough to tell you that it's funny. Sometimes you can see companies come out and blow the cover off the ball, come out, as far as earnings go, beat their expectations, and then come out with rosy guidance, and still the stock sells off. It turns around, sells off after that. One instance of that I recall was Apple back a few years. I think it was 2015 or so. Did the same thing. That was a major top back then. We'll look here on the weekly chart. I think it was back here at this top. If it was February, I think that was in February. Yeah, no, April. That's what it was. Around April, late April, April 28th, if I'm not mistaken. Big pop on earnings, aftermarket rally, pop the next day, and that was it. That earnings beat and the subsequent rally rallied for a day. I think it was that same day after earnings, and then reversed and never looked back and fell from that point 34%. I believe that was that time there, and you can see there's quite a few tops like that. So, tops come after a big extended uptrend, and just because you've had an uptrend doesn't mean it's a top. But now we're going to go through things that that indicate it may be. So let's just start with. Let me go back to NQ, and then I'm going to roll into QQQ. So this video doesn't go forever. I'm not going to get into the S&P 500. I will post some updated charts with some levels there, but as I often say, it's all about tech. It's all about the NASDAQ 100, or at least the tech sector. And the NASDAQ is much more tech heavy than all other indexes out there as far as diversified indexes. And even the S&P 500, although it's not nearly as heavy, it's still about a quarter, over 20% of the weighting of that index, by far the largest. So it's when this breaks, the tech heavy NASDAQ, the S&P 500 will break. You're not going to see the NASDAQ go up or down 10 or 20% without the S&P 500 going up or down, usually a little bit less than that because it's a little less juice in there, with a lot of the dividend paying stocks and utilities, things like that don't fall or rise as much during corrections or rallies. So here's a level, same level as the other day, same level as last couple weeks. This yellow uptrend line, you can see a pretty nice price channel formed by the upper and lower trend lines there, and that's it. And so right now, we've rallied and we've kissed the top of the channel. So far, that's been objective times to either short back down to the bottom of the channel, or if you went long at the bottom of the channel, you can close your longs at the top of the channel, wash, rinse, repeat, as long as that works. That's been the MO. So that's something to note there. The divergences that we had in place at the last high right here, keep moving this. We had divergence here, we had it here, we had it here, we have it here. As long as these indicators continue to make a series of lower lows, and we don't take out those previous highs right there, and that's negative divergence. And as I often say, that nor overbought conditions, they're not sell signals, they're just an indication of the odds for a reversal or correction against the current trend is likely, whether you have positive or negative divergences. All right, so let's get off that. I posted an updated chart this morning. I'll keep those coming as, and I need to, once in a while, if I need to tweak the trend lines or the levels, I'll do so. But as of now, I think that those are the ones to watch. First, the trend line, then that 9110 level. And finally, before I get off this chart, as I said this morning, one thing you need to be aware of is with being that we're now heading into the thicker earnings season, this will be the hump right here over the next week with these market-leading FAANG stocks reporting. The chance of whipsaw signals goes up pretty good because you're going to have some of these companies you'll see will report earnings, and you'll see a big tank after hours or a big rip after hours, and then quite often you'll see that initial rip or dip faded, in other words reversed. So what I would say is don't put too much into what a company does or what the futures do after hours when one of these guys report. It may be the breakdown. Let's just say we get a solid break. That doesn't mean it can't stick. All I'm trying to say is at 9:30 the next day, because all of these market leading FAANG stocks plus Intel, they're all reporting after the market closes over the next week. So you're going to see the after hours trades, whatever the futures are going to do overnight. But then at 9:30 a.m., that's when the institutions, or what I say, the starters, they step onto the playing field. It's much harder for them to navigate in the after hour session trading futures like that. The markets aren't as liquid then. So a lot of the institutional traders and funds and such they'll trade in the morning, and you can see that if you just put up a chart of the futures, and let's say you're looking at the round-the-clock trades, including the Globex trades that occur after hours. You'll see volume surge at 9:30 a.m. when the market opens, and then throughout the day, volume looks like this. If this is the open at 9:30 a.m. and this is a close at 4, volume's always highest in the morning, kind of tapers off. It's like a smiley face and then picks up again towards the close. But then overnight, it'll again taper off, and it's much lower. And so that's why I say don't put too much of a weighting into what happens after hours, especially when you have an earnings report, because there's two components to a company's earnings report. The actual earnings, which come out and right away before the company can even kind of get into the nitty-gritty of why their revenues might have declined or missed or beat. The algos will rip that earnings apart. They'll shred it in milliseconds. They read through it once it's released. It's come out there. It's digitally released. Algos, or the algorithmic trading program, they're looking for keywords, for numbers. They're going to react right away, fire off buy and sell orders. But then things aren't always straightforward. Then the company will come out, they'll explain what happened, why this number was up or down, why this beat, talk about any type of adjustments. And then following that, once all the participants have had time to vet through the earnings report, kind of make heads or tails of it, and then place their bets, their wagers, add to or exit positions. Then you have the company's conference call normally, and they come out then, and most companies will give you forward guidance. Okay, great, we blew the cover off the ball last quarter, but how do things look going forward? Because in the market, keep in mind, most everything, markets are very efficient pricing in things. Yes, there's a volatility, and some companies do have big gaps after earnings, but quite often, and some companies do a much better job at managing those expectations. Quite often, any big move for positive earnings report quite often is priced into the stock. So keep that in mind as well. And so then what happens if a company comes out and then forward guidance is better or worse than expected? That can then turn around, and that's going to be an hour or so sometimes after the earnings came out. All right, so those are the things to look for. And the bottom line, the takeaway from all this is, if you're trading heavy, if you're trading futures, if you're trading QQQ where you're locked out, after the after-hour session closes, all night, no matter what happens, you can't start trading the Qs again until the pre-market session opens the next day. So whatever you're trading, just what I like to do is I like to keep things light around earnings season. I also like to be a little extra selective on taking new positions, especially if they're going to report earnings. I told you Netflix, I suspected that one was going to drop, and that was one I wouldn't add it as an official trade. I decided to wait till after they reported, and I still may add it. And I said, look, if you're a little bit of a aggressive trader, you could establish a position ahead of earnings, and of course they did. They did disappoint. I think I didn't read the whole report. I think subscriber growth was down or something like that. Here's the chart I showed you. It was in a bearish rising wedge, negative divergences right there on the indicators, and it actually broke down right there. The earnings, this was yesterday, they reported Netflix was after the close, and now they're down today, well below that wedge. So you had a breakdown the day of earnings, but remember the earnings came out after the close there. Let me change this color here. So that one, number one, wasn't impulsive, and number two, it was immediately before earnings. So you're either going to establish a position inside the wedge or just before earnings, and then wait. And once you can see the stock clearly has moved lower today, now that's a breakdown. That's impulsive. high volume. Even yesterday was high volume. Earnings are out of the way, so at this point, if you shorted it, you can add to that position with a stop. At this point, stop at break even. The stock has no business. It could go in and back test. So, you have a couple options. Set a stop at break even. It's your entry price. If you shorted it, anticipation of a breakdown. Or you could give it a little bit of room if you want to back test the wedge. And I covered this one as a trade idea. I think it was last week. And last week. First target remains this uptrend line. I expect a reaction there, and we'll go from there. We'll see by the time it gets there, we'll probably have Intel out of the way. Intel reports tomorrow night, and then some of the others. So I'm being flexible with this trade. May add it as an official trade, but what my plan is to see if and when it gets here, decide whether to cover that, maybe look to reshort it on a bounce, or depending on what happens with Intel and everything else, if the tide starts to shift, Intel is the sixth largest component. And then after that, we've got some others coming up. I listed what was Intel's Thursday after the market close. Then we have to wait till Tuesday after the market closes. So you're really not going to know until Wednesday morning what happens after the big dog, Apple, reports. You also have AMD, Advanced Micro. And so where I'm going with that is if, let's say, Tuesday we get down here and Apple reports and the market doesn't like what it saw from Apple, that's probably going to impact the NASDAQ, which will impact Netflix. That's the NASDAQ component. And may cause a breakdown of that trend line and down to that next target around 299. So otherwise, again, I'll have to see how things look if and when we get to this level. But as of now, I want to say that looks good. Still an unofficial trade, but I wanted to do an update there. And then let's talk about the FAANG stocks before I leave the indexes. Let me just talk about this 60-minute chart of QQQ. Zoom in nice and tight here. This is the primary trend line, that first yellow uptrend line that I've had, and I've added a benefit of the doubt trend line. Benefit of the doubt is when I can draw two trend lines, and I think both are valid. This uppermost trend line right here has more reactions along it, and I look for reactions either the candlestick body and or the wick. Or the tail, the shadow, the skinny part. And so what I'm doing is I'm circling each of these reactions here, and there's quite a few on this one. You can exclude this little blip right there because there's enough reactions. It's a very valid trend line. But then down below that second trend line, you can see I also have a few reactions there as well. And so when in doubt, give it the benefit of the doubt, I like to say. The trend has been resilient. So while this may be the breakdown that triggers the correction, you want to be safe. You wait till this trend line goes. One way to trade it, you could take a starter position if that trend line goes, especially on a 60-minute closing basis or a big impulsive candle down through, and then add to it there. You still have support to contend with at 22.21. And this, see, that's their first horizontal support. That probably will align with, let's loop back to that NQ chart. This is why I like to follow a lot of charts because it's all directly related. Let's see, NQ, I've got it down here somewhere. There it is. Okay, so remember we had the trend line, the 60-minute uptrend line, and then just below that, that 91.10, 91.11 level right there, you can see quite a few reactions. So those will come in together. And how that's, how the market treats those levels. Let's say the trend line goes. You could get a bounce back, come back test. That would be another objective short entry. Or do we break down and just go on right on through there? That would be a little more bearish. That would show a little bit of a shift in the supply dynamics of the market right now, meaning, the bulls have been stepping aggressively on every little pullback so far. So if they broke the trend line, that would be the first logical place for them to step in. That's the first support level below the trend line, 91.11 right there. So, and then if that goes, how does 90.22? How do they treat that level, and so on and so forth? I still think, and I think I've said it for the last week or so, when we get a sell signal, we're coming down to at least this 88.90 level right there. Pretty good support. And from where we're at now, we've gone a little higher since I last said that. Now we're looking at about a 3.7% drop. Again, if and when we get a solid sell signal. We don't have that yet. So yes, that's all I'm talking about are the pullbacks, because there are no overhead resistance levels. The market, when it's trading at new highs, there are no levels of resistance to target overhead. You can use all types of different formulas to try to project or guess where the market goes, but a big part of my analysis is incorporating support and resistance trend lines. And again, when you don't have resistance levels overhead, it's hard to target. That's why a lot of the long side trades I have are either continuation patterns that have resistance levels above, or maybe you get a projection off there. So let's say we were, at all-time highs on a security, and we had a very impulsive thrust up that looked something like this. Let's say a security was, basing here, broke out, and then started flagging, had a little bull flag right there. Yeah, in that case, I can take that bull flag pattern and say if we break above it impulsively, the measured target would be the distance of the flagpole added to the breakout point. But in this case, we don't have that. I don't have any clear type of pattern. We haven't been consolidating. This was the last period of consolidation that we had, and it was kind of sloppy. It didn't take the form of any type of continuation pattern like a pennant or a bull flag. Okay, so that again, back to QQQ 60-minute chart. There's a trend line 1, trend line 2, and then 221. I'm sorry. And then, as I was saying, Apple, you have something similar. Here's Apple on the 60-minute chart. Beautiful uptrend line right there. Price channel. You can see the upper line of the price channel, my midpoint line, which is a little bit above the center line, but that's where the reactions come into play. Like I often say, when I see a price channel up or downward sloping, almost always I can draw a midpoint line. Sometimes it's exactly in the middle, sometimes it's a little bit above, a little bit below, but you can see a lot of reactions if you freeze the video and look closely. You come up, you hit it, it's resistance, then you break above, and then once you break above, you usually hit the top of the channel. When you break back down below, it then acts as resistance again, and usually once you break below, the next stop is usually the bottom of the channel. And then wash, rinse, repeat. You can go long at the bottom of the channel, midpoint's resistance. Once you break it, it's usually a quick move up to the top, and vice versa. So you can go back and see how often, how many reactions we've had along there. So right now, we've recently come off the top of the channel here with a little bit of a channel overshoot, negative divergence in place at the time. We still have negative divergence in Apple. And so one of the reasons I wanted to do this video, and I say this often, if the charts are not clearly bullish or bearish, earnings to me are a crapshoot. You might as well just flip a coin or, drop a quarter in a slot machine, because your odds are just random. 50-50 at best. Or really, at that case, maybe go with the prevailing trend. If you're in a bullish trend, the chart on your security isn't clear, well, you might as well give the benefit of the doubt to the trend. Still a gamble. However, when a chart stock has a clearly bullish or clearly bearish technical posture. Now again, regardless of the trend, you can be in a bullish trend, which Apple is, and you got to give it that a weighting there. But the technical posture right now, negative divergences on the 60-minute chart, a very long in the tooth extended price channel. We're doing just rolled off the top of the channel. We've entered the bottom, midpoint of the channel, but we haven't yet touched the bottom. You can see again every other time we broke back down below the midpoint, the bottom of the channel was hit. So because of all that, if I had to bet, and I might lay a bet, like with Netflix, that this one earnings will go this way. I don't care about the initial reaction, what happens in the after-hour session, or even the same day. Usually, at most, one day rally if you are going to get a reversal. In other words, they could pop it on positive earnings like they did, I mentioned before, and then turn around and sell it. So here's a stock, as well as a lot of these, based on the technical posture, not just the 60-minute chart. That's the point of this video. We're going to go look at some things here. Divergences now have been burned through. You can see almost hanging in there. Maybe a slightly higher high on the PPO. RSI is higher. As I often say, divergences are not the be-all end-all. It is a big part of my trading and analysis, but it's not a something that we must have a correction, or if the divergences are not there, we cannot have a top. That's not the case. They're just something useful to help identify the major tops and bottoms, inflection points in the market. But another thing that we're looking at, and I've talked about recently, are the extreme overbought conditions. When you put up an RSI on a chart, the default settings are usually going to be, you'll have a line at 70, that's this red line here, and a line at the 30 level. And anything 70 or above is considered overbought, and anything 30 below is considered oversold. However, that doesn't work for a lot of stocks. It does work quite often. You can see in a lot of cases this runs up to the 70 level cap rallies, but there's also, I like to look at a chart and then add another line, and that line is dependent on the security I'm looking at. So I'll go back like I've done here in Apple, and I'm rolling back. You can see the year break lines here, so you can get an idea of what we're looking at. This is a yearly chart. I'm sorry, a daily candlesticks, and here are your year breaks right here, just to get an idea how many years we're going back. And I look at the extremes. So in the past, how overbought has Apple become? And you can see here about a little bit over the 80 level, and that's about it. And when it gets there, rarely does it stay there very long. You can see that it hits that level, and that's usually where it reverses. Here was a big run up. That was part of early part of the Trump pump, and then sometimes and quite often when you get those overbought readings, you are followed up with a secondary overbought reading that's a little bit lower, and that gives you negative divergences. So as I like to say, many of these tops and these corrections come after an overbought reading. You get a second thrust up to become a little bit less overbought, and that's negative divergence. But sometimes, here, as I'll show you here, you get one and dones, I call them, where you hit the overbought level on the RSI. Let's see if I'm sure there's some here. There was an overbought reading there. There was a one and done right there, and this is a big drop. It won't look like it here on this chart. I've gone back so far. Some of these corrections are measured here, 10%, 17, 13%. This one was quite a bit more right there, and it was I think over 30% if I'm not mistaken. And again, here we are. Even that first reading, by the way, I talked about how a lot of times you'll become overbought and then push back up and become a little less overbought, then the big correction sets in. But even those first readings are usually a decent pullback. Measure that one out for you, just picking one at random here, and that tells me that was about 7.5% drop on that first overbought reading. So where am I going with this? Overbought, just like oversold, they're not in themselves a buy or sell signal, simply because the problem with it is overbought can either stay overbought for a period of time while the security continues to rise, or you can become, you get a little correction and then push back up and become overbought again. So what you want to do is align overbought readings with sell signals, such as a break. In this case, it would be a break of this trend line. It's that simple to me. When this trend line goes, it's pretty well defined. There it is. It comes off the December 3rd lows. Apple's been walking up that trend line. That's the same as the price channel on the 60-minute chart. And based on the fact they're going to report here in just a few days, January 28th, let's see, I'll put a line there for you. It's going to be right there. So let's put a horizontal line to kind of mark our earnings. Let's see if that's there. Yep, January 28th. Remember, they report on the 28th. They're not going to start trading the 29th. And so this is probably, if you're going to have a breakdown, I would say it will be a confirmed breakdown, not like Netflix where sellers got out a little bit early, a little bit nervous for earnings, but you didn't have an impulsive sell-off. It'll be after that. So that's what we're looking at here. And that's why, again, I think the next few days may see the market kind of grind around sideways. But I can tell you this, it's been, yes, a heck of a run-up in Apple especially. But you have to ask yourself, look, Apple's a great company. They are an earnings juggernaut. But how much of the positive earnings, whatever they're going to report, And they do a pretty good job of managing guidance too, by the way. How much of that has already been priced in? You have to ask yourself. And again, if you look at just technicals and don't try to second guess fundamentals all day long, that is a tough game. I can look at technicals and tell you that history shows us, going back here, that when the stock became this overbought, at the very least on the initial tag you had a correction. By the way, we hit overbought right here recently. That was right there, that extreme level, and you can see that resulted in mostly a sideways correction, a little bit correction in price. That was right here after that extreme overbought reading. But here it became even more extreme. In fact, you can see we were above that 81-ish level. We were about 80, that's so small I can hardly make it out, about 86. This was the last time we were that overbought in Apple right there. Right here back in 2018, about early September, and you could have shorted there. Just that reading alone, you would have been positive a little. You would have went back to break even, and then ever so slightly underwater. You can see we're just maybe not even 1% above. So you can see there was just minimal upside, and we corrected mostly sideways. Put in a second lower overbought reading right there, right at the 70 level, and then boom, 30 or something % drop in Apple. So I'm talking about the same thing over and over, that the technicals, all of these stocks, and let's just run through the rest real quick at the FAANG stocks. I'll go back. I have to type in QQQ. My watch list will load. It'll sort all the components on another page here, and I'm clicking on those. Microsoft, January 29th. Same trend line right there. Similar trend line, I should say. Apple, this is a daily chart. Overbought conditions, negative divergence right there. We have Alphabet. This is Class A shares. Extremely overbought. Let's put a line there on that level right here. Here's the RSI up around, pushing above the 80 level right there, or over 81 right now. Let's just take a look and see what happened last couple times the stock was that overbought. Well, right here, and we can measure that out. I'll do that. Let me turn off all the things there. That resulted in a swift drop from that point where, again, that was the last time this stock was as overbought as it is now. About a 16% drop, and again, you can see how quick that happened. If I grab the top, if I can grab the top there where we peaked, sometimes hard to do. Almost got it there. Wow. All right, it's only snap into that candle. I'd have to say, there it is. I got the top of the candle. And now the bottom here, if it snaps to that, about a 17% drop in just 9 trading sessions. Sessions. 11 calendar days, 9 trading sessions, a 17% drop the last time that Alphabet was this overbought. So, you've heard me say before, the risk reward wasn't attractive in the market, and the market continued to go up. Just an unfavorable risk reward is not synonymous with we must go down. It just shows you that given the right catalyst, and you have these conditions, these extreme overbought conditions, you can wipe out days or even weeks or months of gains in just a matter of a few days, and that was the case there. Right here, that was we were that overbought at the time. We set up in a nice little bearish rising wedge pattern there, and from that point we dropped in a matter of just, I don't know, short order, a couple weeks or so, about 8%. And again, this was a previous time right here. And what I'm trying to show you is we didn't always fall immediately. We were that overbought right about there. But what happens, we traded sideways, marginally higher. So you could have shorted on each and every one of these occasions where Alphabet was at, this overbought. And in all instances, you would have either profited right away in very short order, or went slightly underwater. Worst case scenario, you would have been caught in a sideways trade for a few weeks, maybe even a few months there, but never have gone more than just a couple percentage points underwater, and then that trade would have paid off. So that's it. We can go back here again. Last one right there. Boom. That drop was, I need to turn off the annotations, and 18.4% drop in 1.1 months, or 24 trading sessions right there. And then the other one was off just to the left of the screen right there, and that was it. So I just hit every one of the instances where Alphabet Class A shares was this overbought, about 81, 82, and you can see again, You could almost have a strategy of just shorting those overbought levels, giving yourself maybe a 5-6% stop, give it a little time, and you would have paid off in each and every case if you were targeting, I've got to go back and look, 8-10% or more drops. And one way to do it too, you might wonder, well, Randy, okay, well, what price target? If I were to short that, whether it's before or after earnings, what are my targets? Well, as far as this goes, this is almost a parabolic advance right here in Alphabet. It's a vertical. I don't see any support until down here about that 1335.91 level. So you could target that, probably I could put good odds, very good odds to get a reaction there. So that's almost an 11% drop from where we are. You could cover there. Depending on how things look, either reshort after a bounce, or one thing it's nice to do when you have these extreme conditions, especially right now when sentiment is so positive, because nothing will turn sentiment. I don't care if it's nothing other than a quick sharp drop in the market. Again, missile strike against the U.S. doesn't do the trick. What will do the trick, what does rattle investors, is getting their pockets hit hard. So if you were to see this, you're going to see overall sentiment really shift, and there's a possibility then you could get more. So what I'm getting at here, one strategy is cover on 13 just above, always cover a little bit above the actual support level. That was we'll call that 1336. So you maybe cover just right a hair above there or so. Or what I like to do at times is just, if it starts to pan out, periodically lower your stop. So let's say you shorted it like this. Let's go here. And I'm just using this as an example, not that it's my favorite one of the group. Let's say it starts to pan out. At that point, you're up, let's say you're profitable by 3, 5, 7%, whatever your number is on the trade. Lower your stop to entry at that point. Let's say your original stop was up here a little bit. Lower your stop to entry. If it goes down here, continue to lower your stop. Now you can do that by setting a trailing stop with your broker that will automatically adjust downward. You can say a 5% trailing stop, a 3%, and then let it run. Or sometimes I like to just manually ratchet my stops down. So if it gets here, you've lowered your stops now, let's say to protect profits in case it has a reversal and heads on to new highs. So maybe you lower your stop to this point, or maybe even a more aggressive stop, and allow for the potential, because sometimes when you have these extreme conditions, support levels where the buyers quote unquote should step in, like I said, that is a pretty well-defined level, and I would suspect the buyers will step in. They should step in. If I was long-term bullish on Alphabet, that's where I'd be stepping in if it gets there. Well, let me just speak hypothetically. Again, if I was longer-term bullish. However, if they don't, then that's pretty darn bearish. Again, it'll show you that the buyers have washed out for the time being, and they're not stepping in, and the supply-demand dynamics have shifted. So therefore, by allowing that trailing stop, or I'm sorry, trailing your stops and letting your position run, it could open the door for a much larger drop, and then you could be looking at a drop of, instead of about 10-11% on Alphabet, maybe we come on down here to this 1245-ish support. That's about a 16% or so drop, and that strategy works just as well for long trades. There's been a lot of long trades, like the BYND trade. That was a momentum trade, and hit the final target, and it kept going beyond that final target. This is where I thought we'd get a good reaction. Was at 105. Let's see, it was a 60-minute chart. 104.26, and so a strategy like that, it's a momentum stock. You can either book profits there, and in the official trades, I have to put a final target. It'll go on forever and ever. But a lot of times, I'll say just if you like the trade, if it looks good, the momentum's there. At that point, instead of booking profits at 104.26. Raise your stops, maybe set them strategically below the next support level, or even a very tight stop where you're only going to get back 1-2%. But if the momentum continues, 1 or 2% trailing stop wouldn't have been triggered. Or maybe I have to measure those moves there. Let's say a 4 or 5 is a volatile stock. You would have caught all this, and then it would have pulled back, and at some point during the day, because trailing stops are automatically recalculated with every tick higher, it's adjusted. So a 3 or 5% trailing stop, you would have went up caught all that momentum, and then it would have been hit that same day when we reversed intraday off the highs, and you would have been stopped out somewhere along there, and then sidestep this whole give back. So that's just a kind of a tip on how to trade some of these trades, and I try to convey my thoughts as to which ones may continue to run or have larger potential, or if I think there's a very good shot that the end of the run is over, at least the risk reward's very poor, I'll let you know. And again, it's still up to you. Sometimes they just keep going even when they should stop. So. Okay, long video. I'm kind of throwing out everything, trading tips, my thoughts on what may happen. I just wanted to wrap up the last of the FAANGs. Amazon's kind of been lagging. Well, it has been more of a laggard than a lot of the other FAANG stocks. It's not going down, but it's not going up. The stock peaked back in 2018. We're still below that high. There's not a lot to glean off the daily charts. In other words, I don't see any very compelling levels to watch, anything that would trigger a solid sell signal other than some type of big bearish candlestick reversal pattern. Here's your daily chart, divergent high here, correction. More so when you look at the weekly chart, it's a stock that could be indicative of a major top here. We had, let me go back. I didn't even have this marked up. There's a 2007 market top. And the common theme is a lot of these come with negative divergence and extreme overbought conditions. This was the bull market that ended in 2007. Again, log scaling doesn't look like much, but that's a 63% drop right there, what looks like a little blip in Amazon. The other drops are measured, and so even during the bull market, that was the last bear market, 60+% drop. Even during this current bull market, there are, I don't want to call them bear markets, even though technically they were. If something drops 20% or more off its highs, technically that's considered a bear market. But these were corrections within what I call a supersized bull market. So you had negative divergence back in 2011, and that was followed by a 32% drop. You had negative divergence right here, the crosshairs, a little small divergent high. There's your divergence lines, 32% drop. Negative divergence, 14% drop. Negative divergence and overbought readings, extreme overbought readings, just like then, 36% drop. Back then we hit a target that I had at 31% drop, and I figured more to come, and yeah, we got more to come. And I was also set up, not always shown here, but you had positive divergence at the lows. That's things to look for as well. So you had bullish divergence there, and that was the catalyst for, nope, we had it on the, I believe just on maybe on the PPO down there, not the RSI. But what I'm looking at here is it's pretty much flatlined from there. I showed you, if you look at, zoom in real tight, here's the highs back in September, and then almost a double top. We came effectively to that level then back in early October before the drop set in, and you can see right here this line was right about 2043. This top here in July was right about at the October high before we dropped there, and the stock has not exceeded that high. And now what do we have? We have the divergences that were in place at that previous high have only been extended when we hit that second peak right there. So again, I don't want to spend too much time on Amazon. Not one of my favorites, but I did just want to kind of go over all these charts. There's Alphabet, trend line to watch right there, and then Facebook. These are weekly charts, and you can see the same overbought conditions, divergences, all that good stuff. There's Intel. Intel really looks to be setting up for a big reversal at some point here in 2019. You can see the PPO is starting to roll over. It hasn't crossed over yet. I'll be looking for that. If and when we get a bearish crossover on this weekly PPO, so we'll watch Intel closely. It's going to report here in a couple days. That will then, at least in my opinion, what I call confirm the divergence, because we have a series of lower highs right now on the PPO and the RSI. But as momentum indicators, they're still pointing up. They haven't made a crossover. Once it crosses, it effectively puts in a lower peak. We don't have a lower peak right now because this is a moving line, and that line, the momentum is up in Intel, and so they can continue to go up and may burn through the divergences. So that's what I'm looking for. And if it comes, what's going to happen is you're going to have a sell signal here, break of this trend line right here. There's your uptrend line right there. There was your previous uptrend line, previous uptrend line, previous uptrend line. simple stuff to me. I don't want to oversimplify it, but I look at this and it's really that simple. A solid red candle below there gives a sell signal number 1, and an even more powerful sell signal will come on a break below 58, because that's pretty much the previous highs. Intel had peaked out about 58 there. It popped it, made a marginal new high, and then lost it the following week. Couldn't hold it, and then boom, very fast sell-off. And right now we had a breakout above there, another marginal new high. If it fails, trend line break would be sell signal number 1, and a fall drop back below 58 would be sell signal number 2. Probably put the nail in the coffin and take Intel down here to these targets, and that's a big drop if it gets there. And I promise you this: if Intel drops 30 to 36%, it's going to take the semis down with it. And if the semis go down that hard, tech is going down. And if tech goes down, the market's going down. So this is one I'm watching. And they report, what is it again? Thursday? Yeah, Thursday after the market closes. And there's your chart right there. This little regain of the wedge right here, trend line, doesn't mean much. We're right before earnings. Things get a little wonky. As I said in the beginning of the video, I don't put too much stock into things that happen just before and immediately following earnings. Let the dust settle. Friday, by the end of the day Friday, we'll have a good idea which way. You'll probably have a good idea after the close on Thursday, once they report, which way Intel is going to go. But certainly by Friday, once the market opens. And again, that can start to set the tone for earnings season, whether it's good or bad, or it may not have an impact at all. Sometimes one of these companies, the market shrugs it off. So we'll just have to see what happens next week. All right, guys, I'm going to wrap it up here. This has been about as long as a video ever gets, but I wanted to kind of pack all this in, pack in all my thoughts, kind of let you know, volatility this week and next, and it could, if we're going to get a trend change in the market, this is probably when it's going to come. Otherwise, it'll be more of the same. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.